everyone to ETF.com's webinar on our very first ETF report, the Global Investor Survey that is sponsored by Vanguard. I'm super excited for today's discussion. We'll be chatting over the next hour about this survey and its findings. Just a couple of quick housekeeping notes. So the report is available on ETF.com. You will see it right there on the homepage. So if you haven't yet checked it out, please make sure to go over to ETF.com to go and download that report. We have tons of findings that we're going to be going through and discussing in this next hour, but the report is full of a lot of nuggets and insights, and unfortunately, we just can't get through it all over the next hour or so. Now, I want to introduce my two fellow co-panelists. We've got Jeff Benjamin, ETF.com's wealth management editor, as well as Matt Sheridan. He is coming to us from Vanguard. We'll be diving into his experience and what team he works on in just a moment, because he does work with a lot of financial advisors. So we want to dive into a little bit of that to discuss some of his expertise and the insights that he'll be bringing to us today. Now, before we kind of dive into some of the findings that we have in the report, I figured I would just give a little bit of an introduction to the survey itself. So we surveyed over 600 people, both financial advisors and retail investors, for the findings that we're about to discuss. Now, of the investors, more than half had a net worth of more than 1 million, and they ranged in ages of 36 and up. That's half of those investors. Now, the majority of financial advisors are bringing over 21 years of experience, and a fifth of the advisors that we surveyed are managing $500 million in assets and more. Now, we asked them a range of questions, from how they feel about the market, to what sectors they're investing in, to what ETFs they want to add to their portfolios in the future. And so, as I just mentioned, we've got Jeff here to discuss, as well as Matt Sheridan, Senior Investment Consultant of Portfolio Analytics and Consulting Group at Vanguard. So quickly, Matt, let's just first start a little bit. I just kind of gave your title, but for those that are kind of watching and don't entirely know what that means, dive into a little bit about the team that you work on, who you're really working with, and how you kind of work with some of those advisors.
Yeah, for sure, Chris. And I know it's a little bit of a mouthful, but appreciate the opportunity.
I know, I struggled to say it all.
Yeah. And thank you for everyone for taking the time out of your day to listen to what we have to say. But think of it, Kristin, as a portfolio construction team within Vanguard. We work directly with financial advisors and teams. Just to give you an idea in terms of like the sample of portfolios that we typically look at, Kristin, it's usually about 2,000 or so a year. That number keeps going up a little bit just as we ourselves get a little bit more scale. But like it's a range, Kristin, on how teams will interact with us. Some teams will come to us just directly for data analytics, and it could be diagnostics. Like, what does Vanguard think about how we run money for our clients? Other teams may come to us for, more portfolio construction related concepts. Like, should I use emerging market bond funds within a portfolio? If I do, where should I fund those positions from? So it really ranges. I think the neat part about my role in my team is we get some pretty decent insight into what advisors are doing real time with their capital and their clients' capital. So it's a neat intersection between the research and the surveys that you all are doing, but then also I can share some insights in terms of like what we're actually seeing in advisor portfolios on our end.
Right. Well, this is actually perfect because, as I mentioned, we did survey a pretty large and sizable financial advisor audience for some of these results. So let's first just start with a little bit of like the overview, right? It was one of the first questions that we asked in the survey, which is essentially, do people like ETFs in their portfolios, and are they essentially happy with it? And everyone that we surveyed, from both the retail investors to the financial advisors, said they're happy with their ETF performance in their portfolios, and they plan to add more to their portfolios going forward. So I'm curious to know what you think is sort of driving that sentiment. We have seen markets on an upswing, broad markets up over 20% right now. Or do you think that there is something specifically about ETFs themselves that is actually pretty appealing to advisors and to some of those, to their clients and those retail investors that we surveyed?
Yeah, I think both can be true, right? Like I think it's hard to deny, like, equity markets close or at all-time highs, depending on what type of strategies or categories that you're looking at. Like, that certainly helps. But it's, at least in my conversations, Kristin, with our teams and even my colleagues with the advisors that we speak with, and again, this is, them sharing insights too in terms of how they're speaking to their clients, but it's structural, right? Like, most ETFs are lower cost, they're more transparent, they're very tax efficient. Like, clients are more aware of them these days, and they're asking for more ETFs within portfolios. Like, it's hard to read an article on financial services without hearing something about the growth of ETFs, right? And like advisors want to make sure that their clients are comfortable with what they own. But like even in our conversations, Kristen, it's a little bit more nuanced where like there's some parts that you can't even quantify, right? So like there's been a huge evolution for advisors moving to model portfolios. And sometimes there's headaches where if you have some mutual funds in a portfolio and then you have some ETFs in a portfolio and you want to rebalance the portfolio, like some of your investments have intraday trading and you're getting filled at 1:30, and then other parts of your portfolio you might have to wait until the market closes. So just incorporating more ETFs into the mix, especially if clients are comforting with it. I mean, it's one of those things that it just makes a ton of sense for the advisors that we see. And like, so I personally, and even the colleagues that I have on my team, there's now about 20 of us now with the conversations that we're having with advisors. We don't see that momentum stopping anytime soon.
So even because this is a pretty interesting time that we're having this conversation, that we had these insights, we've had a bunch of big events that have happened just over the past couple of weeks, right? Going forward, we've got rate cuts from the Fed. We still have some base cases for a recession still on horizon. So you're not seeing that trend slowing down, even considering, for example, that recession base case still existing, as we hear from some economists and major banks.
No, I think, and it's not just Vanguard that notices this trend, Kristen, but like I can even go back to conversations I was having with teams before, like going back to 2018, 2019. Like the growth of the ETF, I mean, it's taken off for sure in the last couple of years. But it seems like every time we see market volatility, whether it come from a recession or some exogenous event like COVID, like there's actually a spike in ETF adoption. And a lot of it has to do with like most of the assets in the industry are non-qualified. So if you have an opportunity from like a tax loss harvesting perspective, or if your low basis positions give you an opportunity to get out and get into a lower cost solution, like we actually see the adoption of ETFs pick up during market volatility events. Same thing even happened with 2022, where the adoption of fixed income ETFs jumped a ton when bonds were down 14 or 15%. So no, we don't see the trend stopping anytime soon. And even if you look at the products that Vanguard is rolling out, I mean, most of them are predominantly focused in the ETF space, whether it be active or passive. So we continue as a firm to believe that this trend is going to last.
And part of the report, we did actually ask about some of that market sentiment. And we did see, again, both investors and, professionals in the finance space saying, at least in the survey, that they do feel some sort of bullish sentiment going forward in the next 6 months. So I want to ask about, concerns, because we did ask about what are the top concerns that both financial advisors and these retail investors sort of had. And they both selected both politics and recession as their sort of top fears. Recession was the biggest fear for those financial advisors, while it was politics for those retail investors. I'm curious to know how that what some of those investor concerns that you're hearing squares away with what you're hearing from those advisors. How are they talking to their clients about some of those anxieties going forward?
So when I first read through the report, that's sort of where my mind first went, Kristen, because just by virtue of what we do with advisors, they often share what their clients are sending them in terms of questions, right? So it doesn't surprise me. This is honestly one of the benefits of working with a financial advisor. Is like if you really sort of take a step back, like every time you turn on the news, you're hearing about politics, especially with what we just went through over the last couple of weeks. But if you actually think about like the impacts from a dollar and cents perspective on your personal net worth, like recessions have more of an impact than elections do. And we've looked at this a ton of different ways. We've went back over 100 years from a Vanguard perspective and just looked like what happens from a returns perspective, during, certain White House cover. It could be certain elections. It could be election years and non-election years. It could be, Republican president or a Democratic president. And statistically, there really is no difference long term. A recession, on the other hand, though, like you're going to have to worry about potential cash flow from a personal perspective, income. You're going to have to worry about asset prices, both equities, your credit-sensitive bond portfolios, corporate bonds, high-yield bonds. Like the impact from a recession is much more meaningful than like anything election related. So I think like that's one thing to keep in mind. And advisors, I feel like are pretty tuned in on that, which is great. Like this is part of the value of one of the many things that advisors do, like beyond investment management, is even just like behavioral coaching for their clients and sharing research and guidance. Like even I think like an interesting point too, Kristen, is like even if you could figure out who was going to win, who was going to lose, and you just take them on face value on what they say, like a couple of just like realities. It's like when Trump during his first term when he was running, like he was going to take down big tech. And then you fast forward through his first term, and tech was the number one performer. Joe Biden, as he was running, was speaking about fossil fuels and all sorts of ESG issues. And next thing you know, you go through President Biden's term, and energy is the number one performer. So it's like, even if you could figure out the political game, it doesn't necessarily translate to like actionable portfolio recommendations. And like in my conversations with advisors, most of them are pretty aware of that. And I see that as like a huge benefit to the industry, and why like you really should seek out financial advice when you can.
Yeah, Matt, really interesting stuff on the political side, and obviously the report gets a little bit into that, but we've discussed that a lot. I know in our newsroom over the past week, how politics and economics are in many ways and thankfully separate. But I want to take a little bit of a big picture perspective for you. The report shows where advisors have been focused over the last 6 months versus where they're focused over the next 6 months in multiple ways. What are some of your takeaways from their areas of interest?
Yeah, I saw that, Jeff, too, right? Like even like during our planning sessions, like what's pretty interesting to me is like the top 5 are pretty consistent, right? Like core equity, dividend income strategies, sectors, like active strategies, fixed income. I mean, you pretty much name it, like they're pretty consistent. I think, I don't know if there's too much here, right? Could be sampling, but like it seems like fixed income's falling a little bit. Like I think that correlates a little bit to my discussions with advisors and teams, that there's a little bit of fatigue. But I think like if you actually look at the report, I think what sticks out to me is what almost made it to the top 5. Like you look at like smart beta and factor products, just like in the conversations that we're having, they're more complex, they're harder to speak to, they're definitely harder to use in real life. But they're really jumping up, which is interesting. And I think that actually has more to do, Jeff, with just like industry trends. Like if you actually look at like cumulative net flows, like ETFs, mutual funds, it doesn't really matter. Like 40 Act products, and you look at over the last 10 years, like almost all of the cumulative net flows have gone to the cheapest quartile strategies, whether it be active, passive, index fund, or ETF. And it just seems like investors and advisors in our conversations, and even in the data that we see, are getting more sophisticated on how they source active managers, where they're willing to pay for active manager budgets. And I just think that really sticks out to me, because it actually lines up with just the additional usage of these types of products in the portfolios that we continue to see.
Well, yeah, you mentioned active. Advisors seem more interested in active, buffer, and factor ETFs, while retail investors, and this is one of the divergences, retail investors appear more interested in categories like dividend income and high yield bonds. How can advisors use this knowledge to educate clients?
Retail clients and end clients love income strategies. Like I don't think that's going anywhere anytime soon. So when I read through your report, it does not surprise me that end clients want to get more exposure to dividend products and high yield products. I think we're an advisor, and we've done a lot of work within our own, like our investor advisor research center that sits within our advisor business here at Vanguard, has done a ton of work on the value that advisors bring to the table. One of those components that is hard to measure, but it's absolutely something that advisors can and should and are actively doing, is like even practices around like asset location, Jeff. So like if you're going to use those strategies, they tend to be not that tax efficient. So if you can get really good at putting tax inefficient strategies within tax advantaged accounts, so qualified accounts, and you can think of like derivative income type strategies, high yield type strategies, where you may have to give 40 to 50% of your gross returns to the IRS in the form of tax drag. Like if you can put those inside of qualified accounts, like you may be able to add 50 to 60 basis points of after tax returns onto your client's statements, which is a big deal. And then like within those qualified accounts, just go a little bit more of a total return approach to managing income. I know it sort of goes counter and it's harder to do, it's more complex, but it actually might be more tax efficient, and it might just be more diversified and like a lower volatility strategy to actually just take some of your like principal out and complement that with income, versus just trying to get the highest yielding investment categories within the portfolio. There's risk involved with that. And that's really where advisors, we feel strongly, can really step in and add some serious value.
So I'm glad we're chatting about this. And just another really quick housekeeping note, because we just mentioned active, and I should also say that it is actually the special theme of this year's report. So we will be diving a little bit more into active in just a moment, but let's continue on talking about some of those trends and where we are seeing, this appetite going forward. So over the past 6 months, we saw an increased appetite for core equities, fixed income, thematic, and as you were just talking about, those dividend and income ETFs among advisors. Now, how are you seeing advisors use ETFs to really gain access to some of those categories? You were just touching on it, but just would love to dive into that a little bit more.
I would say, like, if you can just, Kristen, paint with like a broad brush. And again, I know I'm generalizing here, but in the portfolio data that we look at, and we look at roughly about 500 different unique advisor models per quarter. So we have a pretty decent sample size, and this is like real capital at work. What we find is advisors they're using index products like actively. So it's like the allocation to passive is going up within a portfolio. If you're looking at it from like a position sizing standpoint, like an active fund versus an index fund, whether you choose an ETF or whether you choose a mutual fund, but they're being active with it. So it could be like adding mid and small cap exposure passive products on top of an active leaning portfolio, which in and of itself could be an active call. So like there's ways that we can look through that. So like if you even cut our sample up, and we've done this a lot of different ways just to pull out insights, and we can share this even with the audience if they want to reach out to us. But like if you actually look at the allocation to small and mid cap equities as an example, like you just look at the equity portfolio, and we say, okay, look, we're going to break all these portfolios into two. And we're going to say, the advisors that lean most active are in group one, the advisors that lean most index are in group two. And you look at like their size factor exposure, it's almost identical. So it's like the position sizing the index might go up, but like the active risk within the portfolio remains. So like whether you insert like a dividend product in there or a smart beta type product in there, whatever it might be, they're definitely using more ETFs, more index funds, but like the active profiles aren't really moving that much. Like even like where my mind goes to is like I was working with a large bank investment committee last week, and like they are predominantly active equity in the U.S. large cap space. But what they found is, their managers just consistently underweight the top 50 names in the index, and it's been hurting them from a performance and tracking error perspective. Like they went out and got a top 50 S&P ETF and laid it on top of their active strategies, which is like filling a gap that their active managers were leaving behind. Like their allocation to index certainly went up, but that index product that they're using is not a broad market index fund. So it's not purely passive, but it's a way for them to be active really in the portfolio. So it's like unique. And I just think like they're using it in so many different neat ways where you can be really surgical, which like is an evolution in the business. And it's a really exciting time to be an allocator for sure.
I love that kind of what you were saying. It's like, this is an active strategy, even though it's not exactly an active product. And we do talk about that a little bit more, where we kind of are seeing advisors prefer active versus kind of index. And I don't want to jump ahead too much because then this whole thing will go off the rails and we'll be jumping all around. But so looking at least when it comes to trends, we were just talking how advisors have sort of been looking at these sort of portfolios, at least in the past and currently, but then going forward, we haven't seen those appetites change that much. And you were just talking about that, like, this is what they're currently doing. So then what do you think that indicates about how advisors are kind of seeing the markets, that their strategies as they're looking at it, or what their appetites have been over the last 6 months, isn't changing when we look at the next 6 months?
Yeah, I would back that up in terms of just like an appetite. I mean, it has been pretty consistent, Kristen, across my team and even my division, where the clients and the advisors that we speak to are concerned over very similar topics. It hasn't really changed that much. It's like equity market concentration is a big one. That tends to be a reason why they often lean towards mid or small cap stocks within the US markets. It's why they typically will add some of these diversifying categories to the mix. It could be concerns over a global recession. It's like that would be one of the reasons why we see such a strong like US home bias within the equity portfolios. You can even think like rate, still there are many teams, even though rates have gone from, let's just say like 0.5% up to, close to 5% on the bond side, there are still a lot of teams out there. They're still really concerned about interest rates going up. 2022 was a rough year. So like we're still seeing many portfolios that are really short in duration. So like been pretty consistent, but like to me, that doesn't, jump out as like an asterisk type thing to look at. But like I would actually corroborate it from my end.
Okay, Matt, you mentioned the Fed cutting rates. I mean, I don't know how big the fear is that the Fed might raise rates at this point, but they're currently in a rate cut cycle. Do you anticipate advisors are adjusting client portfolios in alignment with what the Fed might do next, or are they already doing that?
It depends, and like Jeff, just to clarify, it's not that advisors are overly concerned about interest rates going up. Like there's just like a lot more protection in the bond market mathematically today, which we can get into if you want to today, than there was before 2022, right? So you just have a lot higher yields to offset any price depreciation in the bond market. But like we look at duration profiles across, we looked at about 1,000 different bond models and analyzed about 1,000 different bond models through the first half of the year on our end. And 3 out of 4 portfolios, Jeff, are underweight their policy benchmarks duration. So if I would read that through as, many teams are still a little concerned and they're not really rushing to really move that much when it comes to duration because of what the Fed's doing. But like we're having a lot of those conversations. So I would say like the capital is beginning to move, and you're seeing that through like flows. If you look at industry trends, where like core managers, core plus managers, things like that, even some like just purely broad market index bond funds are seeing flows. So like, yeah, teams are thinking through it. I think like the simplest way to like, if you really want to kind of like just keep it as simple as possible, like if you go back to 2020 or 2021, Jeff, and you wanted to distribute 4% of your client's bond portfolio to your clients, like 100% of that bond allocation was going to go to emerging market debt or high yield. Like that was your choice. Now, like it doesn't matter what tenor of the curve you go to from a treasury market perspective or even investment grade corporates, you can get 4.5% distribution. So it's like in one world, which is not too long ago, you had to own a really, really high credit beta portfolio to distribute 4%. Now you can do that in treasuries. So like teams are starting to think through like, how do I simplify my bond portfolio? I have like a lot of high cost managers. I have a lot of complexity built into my bond allocation. Now it seems like I don't really have to do that anymore. So I think it's like it all kind of ties in where teams are like it's not that they're moving because of what the Fed does, because the Fed can only really control the front end of the curve, not like the belly or the back end. But it's like all getting wrapped into one where it's like this opportunity to kind of refresh a bond allocation, given the fact that we're just in a new world from a bond perspective.
Okay, I want to talk a little bit about income generating ETFs, as it's also of interest to advisors and investors. Why do you think advisors are increasing their allocations to these type of ETFs at this point in the cycle?
Client demand. I mean, this goes back to Kristin's original question, Jeff, where like these income generating ETFs are spitting off huge distributions. And like they may be tax inefficient, in qualified accounts, which I spoke to. But if they're in qualified accounts or even if they're not, it just might be something that clients are open to. And most of the teams, Jeff, that we interact with are trying their best to diversify away from like US mega cap growth allocations. Like they're trying their best because they really want to diversify away from it for a host of different reasons. And if this is what can get your clients like out of those positions and into something that's a little bit diversifying, then like honestly, it makes sense. Like you can build the best portfolio you want. That's like the most academic in nature. But if your client's not holding on to it, it doesn't really matter. So like the best portfolio is something that you can hold on to. And it's like the prospect of, higher income streams and like that search for passive income that everyone's looking for, like client preference and demand. The fact like if you can wait for those strategies, it takes a long time to show this, but they tend to have lower volatility because of those high distribution years. Like it's easier to see those in like down years than it is up years, but that can come through from a portfolio performance perspective. But again, like we see it in the flows. That's another trend that it happens in our portfolios. It shows up in your report. And I personally, I don't see that going anywhere.
Okay. Why does it still seem like investors are always underallocated to fixed income? I don't know if this is a result of the bull market but it always seems like there could be more fixed income. Where are you in there? What are you hearing from advisors?
Recency bias, right? Like it's been a really, really hard time to be invested in bonds. Like 2022 was bad, But like even before 2022, Jeff, like bonds weren't really falling, but they weren't really giving you any return. I mean, if you, like you're getting maybe like 1.5% yield on the ag at one point. I mean, that's a really, really tough asset class to hold on to. So it tends to be more psychological. I even think just like the types of categories we're seeing being used within portfolios, like product innovation. There are just new types of strategies rolling out, it seems like on a weekly basis. So whether you want to use buffer funds or you want to use derivative income funds or equity long short funds or some sort of other alternative strategy, like there's just so many more options out there today than what there were 8, 9, 10, 11 years ago, especially in the ETF space. So it's like you combine that with the fact that we're still in a drawdown from a total return perspective with bonds. We're still in a drawdown. You think through like the Fed starts cutting, a month and a half ago. And since that point, bonds are underperforming cash, right? But again, like the Fed doesn't necessarily control the long end. So like that's kind of bringing up bad memories from 2022. It's like all of this is happening is one of the reasons, Jeff, why we just try to say to advisors, like if you're going to own fixed income, just align the duration of your bond portfolios with the duration of what your clients actually need. So a way to keep yourself out of trouble is that if you need capital in 2 or 3 years, make sure that your bond allocation, or at least that piece of the portfolio, has a duration profile less than 2 years. And as long as like if rates go up, but you have a duration profile that's below where your need for capital is, you should mathematically be pretty in pretty decent shape. Like where you get yourself into trouble is that like you're holding a 5 duration product and you need your capital in 2 years. Like at that point, like it's a little speculative, but there are ways to use duration in a way where it can make you feel a little bit more comfortable with fixed income. But we see it within our portfolios, and I think a lot of it in the conversations we had, Jeff, has to do with like what we just experienced. Like that was a once in 100-year type event, 2022, and it's just like it's hard to ignore that in these types of discussions.
Well, on the fixed income point, so I do want to talk about tech next, but I am just sort of curious, why shouldn't, I mean, just talking a little bit further, shouldn't advisors kind of move away from fixed income? Because we do see, that advisors are more inclined to actually decrease or just simply maintain exposure to that category.
Mathematically, and not psychologically, there's math. As interest rates go higher, your forward-looking returns for bonds actually get better. So like that's why clients, advisors, end users, it doesn't really matter. Our approach is like what we experienced through 2022 got us back to an environment where bonds can carry above their weight. Like even just think, like Kristin, like think about like a 60-40 portfolio. If the 40% of your portfolio is giving you a yield of 1.5%, and you account for the size of the sleeve within the 60-40 portfolio, which is 40%. From a total return perspective, that gets you around 50 or 60 basis points of total return. Now, if that same 40%, is yielding you 5%, and again, like most portfolios we look at are yielding more than 5% because, advisors really like credit in bond portfolios, like that same 40% allocation is now contributing 2% of total returns. So your contribution to total returns from a 60-40 or a balanced portfolio perspective just went up 4x. Like in our opinion, like that's not a time to move away from the asset class, especially during a moment where you can make an argument that U.S. equities are at least in some pockets of the U.S. equity market, not the whole thing, but there are some pockets of the U.S. equity market, like tech. You mentioned tech, that are extremely overvalued, even in any sort of risk model that we run inside of the firm. So they just tend to be, in our opinion, like a better asset class to own moving forward as interest rates go higher. And especially if you look long term, Kristin, like the longer term you go, and I'm not talking about like 3 years, but like if you go out 7 years, 8 years, 9 years, 10 years, like the big component of bond total returns that matter the most are the coupons. And you reinvest in the coupons, not the movement of the price of the bond on any given month or every given any given quarter. So it's just like the math is such that like bonds get more attractive as yields go up. And like that is just like the purest reason why, from like a Vanguard perspective, we keep saying the same thing, which is like bonds are back. This is now the time that you should be rebalancing back into bonds within a portfolio just because of how much more weight they can carry within a balanced portfolio.
So here's one area that people are not shying away from, investors, not advisors, really no one, and it's tech. It's all anyone wants. I can understand that. If you look at some of these returns year to date, you know you're going to be outperforming the broad market. So are you hearing advisors talk about the fact that they're a little bit worried about their client diversification when all their clients want is tech, more tech, and then even more tech on top of that?
Yes. Yes. Like outside of like wanting to talk about fixed income portfolio construction, like US equity market, like it all rhymes, like market concentration, equity home bias, tech, like you can't talk about one without the other. What's interesting though, and we do a lot of work on this, Kristin, but if you actually look and you look at an advisor's allocation to tech relative to something like the US benchmark, it's actually more common within the portfolios that we see that advisors are underweight technology than overweight.
Oh, okay.
That doesn't necessarily mean that like that's their intention, but that's just inevitably what happens. Because think about it, like if you start with a benchmark weight, which is just like the total market, which is heavy, heavy geared towards second, like you throw one small cap active manager on top of it, or you throw one allocation to an international equity over top of it. Like every dollar you move out of a US broad market index fund will essentially take a proportion, and it tends to be a high proportion out of tech. So like we often see, like you'll see like the Qs or like some of these products and like Vanguard growth products and things like that inside of portfolios. But like even those explicit positions can't offset what active managers or especially what factor strategies, like by definition of a factor product, what they're doing within a portfolio. So like that actually tends to be something that we believe in. Like we think it's really prudent to diversify away from mega cap growth at this point. It's like where all of our models are pointing. It's hard to do in real time, but it's probably the number. I put it in the top 3 of things that advisors want to talk to us about, Kristin, just because they're getting poked by their clients on this topic.
Right.
But it's definitely there and showing up in our conversations.
Is this, do you think, an opportunity? Is it a hurdle that you're hearing from some of these advisors when it comes to like that education piece? If they are constantly, kind of getting some of those or fielding some of those questions about, oh, why don't we have more tech in this portfolio? And is that the opportunity when it comes to the education for that retail investor around, the portfolio rebalancing or what diversification looks like, or why some of those strategies you're just mentioning about actually perhaps being underweight tech is actually a better move for them?
It's an opportunity, yes, for sure, to educate a client. It's an opportunity for us to educate advisors on our views and also just like what other teams are doing, just because of how broad this concern is. But I think both can exist at the same time. I think it could be an opportunity and also a challenge. Look at this year, right? Like tech is outperforming again this year. Growth is outperforming again this year. U.S. equities are outperforming again this year, and it keeps happening, right? So it's not that like when Vanguard says we're more constructive on really like anything other than large cap tech, like we just think there's a merit to having a portfolio to diversify. Most of these models are very long term biased, so like you have to wait long periods of time, which is just like hard emotionally to do. The easiest form of risk management within a portfolio by far and away is just rebalancing. We've done a lot of work on this. It doesn't matter if you rebalance. I mean, it does, but like the margin of error is pretty tight. But like whether you're looking at like quarterly rebalances, semi-annual rebalances, or even like annual rebalances, they're pretty tight. It's just the fact that you rebalance reduces risk within a portfolio for reasons like this. So like we would say, take this opportunity to refresh your portfolio. There are certain pockets of your portfolio that carried tremendous weight over the last, call it 3 to 4 years, even if you go back further, depending on what you're actually looking at. But like overlays and tax loss harvesting on top of it. Like there are a lot of small cap value funds or specific types of bond strategies or factor-based products that might be selling at really, really relative discounts relative to tech that you might have an opportunity to freshen up a portfolio. Potentially, you never know, like book some losses at the same time, and then just kind of reduce risk within the portfolio. So it's definitely an opportunity, but it will in our discussions that we're having, it's absolutely a hurdle for these teams that we're working with.
Now, as promised, I want to talk about active, and just a reminder, it is actually the special theme of this year's report. The report, by the way, has been dropped into the chat. So anyone who is on the webinar right now can go and access the chat so that you can see the link to go directly to the report. Feel free to follow along with us for the remainder of the webinar. Now, you were talking a little bit ago, Matt, about this sort of active strategy, even when using non-actives. What do you think is kind of just in general driving this clearly an increased interest towards more active and this sort of active strategy inside of a portfolio?
You are seeing more, there are still teams out there, at least in what we see, Kristin, there are still teams out there that feel very confident in like your traditional bottoms up stock or bond selectors, right? Like, so you're always going to have advisors and even retail clients that, believe in managers, right? Like there's a bunch of them out there that are good. It takes a while for some of the cyclicality to work itself through from an excess return perspective. But if you have patience, there are some managers, especially if you go to low cost managers, that can really add value. Where we typically see the active allocations, at least on the equity side, like we're seeing more and more of these, especially within ETFs, but we'll see them in like non-traditional type strategies, Kristin. So like your derivative income allocations, your equity long short type products. We'll see them in like factor-based products. So there are index factor products and then also active factor-based products. Like you might have like a momentum fund where the momentum of the market is changing and the ETF cannot rebalance because there's a set date by which it has to reconstitute. Or like an active strategy, there's active managers that could do that potentially on a daily basis. So it's like the non-traditional strategies we see, some factor strategies, but like fixed income, it is just so far and away more biased towards active in the portfolios that we see, where about 2/3 of the bond allocations within the portfolios that we analyze is active, about 2/3. So it's clients tell us it's about credit research. It could be sector rotation within the bond market. So the inclusion or the exclusion of EM or high yield products generally sourced through like multi-sector strategies or core plus allocations. Like that, like those are really like sort of the areas where, at least in our eyes, we don't really see anything changing from advisor preferences towards active.
So I'm glad you mentioned that because I'm actually going to kind of read down like some of those findings that you're kind of hinting at right now. So we saw advisors prefer active for the following categories: emerging markets, small caps, high yield bonds. I know you were just mentioning those high yields, but they preferred index for aggregate bonds, large and mid cap equities, and treasuries. So what do you think is actually driving some of that preference or interest of active versus index in some of those different categories?
A lot of it, I think, is the evolution of advisors and advisors alpha. We do a lot of research on this, where advisors are getting really, really, not that they haven't been, but they're just getting really diligent on where they source and how they allocate active fee budgets. The data clearly shows, and like this is not just Vanguard data. You can go to like Morningstar data on this. So like they put out every 6 months like an active passive barometer you can take a look at, where they'll break it down per category and just like show hit rates for different categories and subcategories. And then they'll also break it out, which is really helpful sometimes, like based on like cost quintiles. And what you'll see is like even for the subcategories where it's really, really hard to beat active management, like lower cost funds, lower cost active funds have such better chances and probabilities of success than higher cost funds. So like that's number one. But high yield emerging markets, like you can almost get your probabilities of success up to like 40% or so in those areas, which may not seem high from being able to source an active manager that can outperform. But like if you compare that to large cap or mid cap equities within the US market, even if you go to the lowest quintile cost, like you're looking at probabilities of outperforming indexes like sub 20% over a 10-year period. So advisors are just getting really diligent on where they source those active managers from. Like treasuries, there's not much alpha to be had in the treasury market, which is why like when we see treasury positions within a portfolio, like explicit treasury positions, ones that aren't embedded inside of active mandates, they're typically index based. So that lines up with what we see. But like those chances of success of outperforming, especially US large cap benchmarks, are just really, really at odds with like just again probabilities, which is why advisors tend to avoid those areas. And we even see it within our portfolios that we analyze.
So then curious, based on some of those findings, are those the asset classes, those ones that we mentioned where the preference tilts towards active, right? Again, so that's going to be EM, small caps, high yield bonds. Are those the ones that present the biggest opportunities when it comes to active management? Or are there other asset classes or other ETF categories that perhaps we haven't mentioned or have thought about where their opportunities are big for that active management?
No, it lines up with us. I mean, there's just some areas, and even if you look at Vanguard's products, like we have diversified approaches to how we manage international equities, emerging market equities. We have a huge fixed income offer. We're one of the largest active managers on the street when it comes to fixed income management. Like the fixed income asset class in particular, Kristin, it's still very opaque. It's complex. It's ripe for active managers to go through and pick the right credits. You think about like if you were managing, like let's just say you're managing a portfolio for clients and you're using individual equities, like Apple stock is Apple stock is Apple stock. It's the same for everybody. But if Apple has, 16 or 17 CUSIPs on its balance sheet, every single one of those bonds has a different risk profile, has a different duration profile, has a different coupon. Like the attributes even within the same company change. So like advisors just in our conversations typically just sub that out, whether it be through SMAs or through mutual funds or active ETFs, whatever it might be, just because like they want to lean towards credit because there is such a high persistence in corporate bonds outperforming treasury bonds. And like they know that, the research says that, and they believe in it. And that's what an active manager can do. But it's like for like those reasons, inclusive of like others as well. Those aren't just it, but those are some of the top ones that come to mind where it's like advisors just have such an appetite for active fixed income.
Hey Matt, let's talk a little bit about the logistics of the money in motion. As advisors increase their interest in active strategies, the money has to come from somewhere. The survey suggests that it's coming largely from active mutual funds and index ETFs. I mean, is that surprising to you, considering how much money there is sitting on the sidelines right now?
No, it's not. Not to us. Look, cash. I see this even in my own research. Like you listen to podcasts, you read articles, blogs, like you pretty much name it. Even in house, like cash, not like nominal cash levels are at all-time highs, but like they tend to be at all-time highs. Like they plateau at times, and the rates of change slow down a little bit, and then they spike up for some sort of reason. So they tend to be like more planning tools. It's not like families are going out and saying, "Hey, look, like I have, 50,000 in a money market just for a rainy day, and like let me go buy Nvidia stock with it," right? So it's like you can understand like why you would look at cash, but like you have to normalize it somehow. That's like what we usually say, Jeff. So it's like compare the cash to like net worth, compare cash to level of market cap, like compare it to something. And typically what happens is when you compare it to like the fact that we've just seen asset price inflation, like it actually doesn't look that high relative to history. And like even in our data, what's interesting, and there's different ways we can look at this, but like if you look, just so it's a way for us to even look at it, Jeff, but like if you look over the last 5 years, in the active equity space in particular, the active allocation within the portfolio is typically around 30%. And again, I'm generalizing here, but it's roughly about 30%. And it's been that way for about 5 years. But if you look at the usage and the sizing of active equity ETFs, the usage is up 6x. And the position sizing within a portfolio of an active equity ETF is up about 3x. So we're seeing them use 6 times as much. We're seeing them sized 3 times higher over the last 5 years. But the active allocation within the sleeve is staying consistent. So the only way for that to really occur is for like active equity funds to lose a percentage as a percentage of market share, and active ETFs to gain that. And you can even see that in your survey. What jumped out to me is just like where you see the next 6 months allocations, like active mutual funds going down and active ETFs going up. Like we're even seeing that right now with the real money in the portfolios that we're analyzing for advisors.
Let's look a little bit more into the way these active ETFs are being used in client portfolios. According to the survey data, it doesn't seem to be a real consensus. Some advisors are using active as a core, some are using it as a satellite position, some trade active less frequently than they're trading their index ETFs. Is there any guidance you can provide advisors when they trade ETFs and build client portfolios?
Yeah, I'll tell you, Jeff, and our audience the same thing that myself and my colleagues share with the advisors that we consult with. It's like, don't look for the perfect solution. There is no such thing. Right? There are literally a million different ways you can build a portfolio for a client. Like ETFs, active funds, they're not all created equal. So like one active ETF can be inside of the same category as another active ETF. And the tracking error budget, the percentage of active share, the historical turnover ratios, the explicit and the implicit costs associated with owning that ETF could be dramatically different. And like in one scenario, you might want to, assign, fund A an allocation or a weight of 25%, and fund B, even though they sit within the same category, should be a 5% weight. It really just depends. Like what we go back to is there's just understanding there's a benefits of both. The benefits can be accretive. One, the way I think through this is like when you're pairing active and index funds together, especially active funds, you are going to see drawdowns associated with their excess returns. Like there's cyclicality in excess returns. You can't outperform without underperforming. If you only had active managers in the mix and a client calls you up and says, hey, I want to rebalance or I need to take money out of my account, there's a high likelihood that you're going to be forced to sell a manager in an excess return drawdown. If you buoy that with an index product, like you give yourself some optionality. So if the active manager is underperforming, you can liquidate or you can rebalance with the index product. And that tends to be a really good way, like practically, like a rationale, Jeff, to like pair active and passive together. The other aspect too, and we speak about this a lot, is like Kristin and you and I were discussing this, where it's like large cap tech. Like a lot of people look at this as like a bug to indexing, that like they can become overly concentrated, which like in reality like could be true, but also like they force you to do things that you wouldn't normally do psychologically. Like they force you to hold on to your winners. So like humans, like the human condition is, a stock goes down 50%, we want to add to it. If a stock goes up 100%, we want to sell it. But like the research shows that most of the equity returns are really attributable to a very small amount of stocks. And the only way to guarantee that you can hold those winners is if you own some index products with it. So it's like there is no right solution. The only thing that I would say in terms of like just something to keep in mind is like we would not trade actively managed ETFs, meaning like actively go in and out of them and try to time them. Timing an index-based product is totally different than trying to time an actively based product. And like you just have to be willing to hold it for a pretty decent amount of time, just because of that cyclicality that you're going to get in those alpha streams. For whether you're dealing with fixed income managers or active managers, they're both there.
Okay, in the little bit of time we have left, a few more things to hit on here if we can. It was interesting to note that performance, fees, and tax efficiency are the top three factors advisors consider when selecting an index ETF. And those three factors map over closely to what advisors look for when evaluating an active ETFs. Is it right that advisors should be prioritizing active and index in the same manner? I mean, are there other factors that maybe should be a bigger priority?
I think it's fine. I think like you can't avoid performance, especially as an advisor, because it's what your clients hold you to. Mm-hmm. So it's just always going to be a part of the conversation. Looking at expense ratios, like for both, it again, like makes a ton of sense. Tax efficiency, it's one of the keys behind, like on top of transparency, like why ETF adoption has grown so dramatically. In terms of factors, like I'll maybe say one for active and one for passive. So one for active. When you're looking at tax efficiency for some of these active equity ETFs, in theory, and most likely in reality, the active ETF is going to be more tax efficient than the active mutual fund. However, I think it's important to understand that most of these active equity ETFs are predominantly in inflow mode. So these portfolio managers are just buying every single month as money flowing into these active equity strategies. At some point, the ratio between active equity funds and active equity ETFs are going to reach some equilibrium. And when they do, where there's like outflows coming out of the ETFs, like that's going to be a better time to really assess the tax efficiency of the vehicle, which should exist. But it's just like a word of caution that most of these products, it's important to know that they're just in inflow mode. Like on the index side, it's like we often see, Jeff, where clients will come to us, advisors will say, like, look, like I want to diversify asset managers and issuers. I don't want to have all Vanguard product in a portfolio. Maybe I want to pair with maybe I want to pair with BlackRock, or I want to pair it with State Street, which is all fine, well and good. And there's reasons behind that why they want to do it. But a word of caution is like when from like an equity index construction perspective, it's really easy to start mixing index providers, which are different than the issuers. The issuers are the asset managers. The index providers are like S&P, Dow Jones, or Russell, or CRSP, whoever it might be. And when you start doing that, it's pretty easy to start creating gaps and overlaps within an equity portfolio. And you almost start to implement active risk within like your beta building blocks, which just can really throw you off a bit. Like we wrote a piece on this, and you can download this off the advisor site with Vanguard, but we wrote a piece on this, my team, on just like when rebuilding beta gets you more than you bargained for. It's just a piece that lays out like how easy it can become to really like just add some active risk into a beta oriented portfolio. So like that would be like 2 words of caution that I would probably add on to those 3. But those 3 make a ton of sense to me.
Okay. This is probably going to be our final question, but I thought this was kind of interesting that, and I think this is something that has evolved over time, especially as the ETF industry has grown and expanded and welcomed in smaller players, if you will, or more, I guess, fringe players, boutiques, whatever. The most important criteria among financial advisors when looking at an ETF, the least important criteria among advisors is AUM of the ETF, the trading volume of the ETF, and the issuer, the ETF issuer. Does this suggest that advisors are looking past these factors altogether, or do they still care about them?
No, I don't think it suggests that. Look, and again, like in the discussions that we have here, no. Look, advisors do not want to get caught in an ETF that closes. Just like operationally, like the plumbing of that, they don't want to get involved in it. So for better or worse, sometimes level of AUM is a first place they go to look at, right? Like if you're, call it like a mid-tier large RIA, you're managing a couple $2 billion and you have, you want to allocate a 5 or 6% weight to some nuanced factor-based product that has a couple $100 million in AUM, like it actually doesn't take that large of an allocation within your firm to actually become the number 1 holder of that ETF. That's usually not a position that too many firms that we talk to want to be in. Like brand diversification matters. Like they don't want to, and from what advisors say to us is like they might love Vanguard, but like just in case something comes out where they're not, their clients have issues with Vanguard, like they just want to make sure that they have different issuers and brands within their overall portfolio. And I touch base on this, but it's important. Like the evolution of models has totally changed the game. So like when you think about like volume, if you're a high net worth, like Kristin mentioned, like there's, half of the sample of retail advisors on the phone have more than $1 million in assets. Let's just say you have $1 million and you want to allocate an 8% weight to a fund, that's $80,000. You might be trading a couple hundred shares of stock of an ETF. If you have 100 million in a model and you want to allocate 8%, that's an $80 million position. So you might, instead of trading a couple hundred shares, you might be trading 75,000 shares in an ETF. Like that's a totally different game in terms of like making sure that you're comfortable with the average daily volume in an ETF, the bid-ask spread, historical premium and discounts associated, like the volatility of the premium and discounts, and like how much of a market impact you can have. So like stuff like that doesn't surprise me, just because advisors tend to be more client centric. They want to make sure that they're not confusing their clients, they're not putting their clients off sides. So some of these parts that like you may overlook if you didn't have to worry about managing wealth for other people, like actually might take the forefront of those conversations. And like it doesn't surprise me that we continue to get those types of discussions on our end, Jeff.
So I wish everyone in the audience could kind of see like how many more questions we had that we wanted to talk about with you today. But obviously we just had so much to get through and not enough time to do it. So I kind of want to use this again as another point of reminder for everyone who is watching right now and who is listening to please go check out ETF.com so you can just go and download the Global Investor Survey. There is so many more insights that, as I just mentioned, we were not able to get through today. Now, I know, Matt, that your team and you yourself, you work with so many advisors. So for any advisors that are on the call that want to consult with you, what is the best way for them to get in contact with you?
Yeah, it's a good question. Just reach out to your local sales executive team, at Vanguard, and you can feel free to set up a meeting, a call, even just communicate via email with, some of our advisor solutions offers. Like Kristin and I work on our portfolio construction team, but we have product specialists, we have investment research specialists, we have financial planning specialists that are just like deep on Medicare and estate planning, and we have direct indexing specialists. Like there's so many different ways. What I would say is just like go on our advisor site at Vanguard. If you can't find or you do not know who your sales executive is, you can always request a consultation directly through the website. So feel free to use that tool and that resources as well.
All right, perfect. Well, thank you so much, Matt. And thank you so much, Jeff, for joining me and in this conversation. And I want to thank everyone that's watching for joining. Now, as a quick reminder, an on-demand version of this webinar will be sent out tomorrow. as well as Matt was mentioning, some of those white papers, that research and that information. Vanguard's white papers will also be sent to everyone. Those white papers will be covering the ETF industry and index attribution. Now, everyone who attended will also be getting a special discount offer from us to subscribe to ETF.com. Part of the benefits of those subscriptions is webinars just like this, as well as unlimited access to a lot of our amazing tools, which a lot of advisors say that they absolutely love to use. But thanks everyone for tuning in. Be sure to go check out the Global Investor Survey. Thanks so much, everyone.